Good morning, everybody. I'm Gary Wayne, founder of A1 Solutions. We work with founders, leaders, and teams and financial services businesses to improve efficiency, scale intelligently, and grow through smarter use of technology, systems, and operational strategy. Today's episode is titled Building the Future, Venture Capital, and Civilizational Growth. Today's discussion is about how capital is deployed in the future, not just for returns, but to shape industries, infrastructure, and long-term outcomes. I'm joined by Alex J. Seleska, founder and CEO of Sparton Capital, and a driving force behind Sparton Ventures, a boutique investment platform focused on venture, property, and future-orientated capital strategies. Alex, it's great to have you on Wise Tech for Wise Money. How are you today? And maybe we could start with a little bit of your journey, your history, and how you got to where you are in Texas.
Sure, absolutely. Well, good to be here, Gary. Thank you for having me on. So, let me start at what would I suppose approximate the beginning of the journey, as it were. I went into my career in my late teens with no idea what the hell I actually wanted to do with my life whatsoever, and ended up working in the money markets in the City of London. We were trading euro and Brady bonds and so on. And to be honest, at that age, I think I was 19, 20 when I was in there. I had no idea what the hell was going on. I had no idea what any of it meant. It was numbers on screens that seemed relatively meaningless, and people shouting at each other. That was pretty much all that seemed to be happening there.
What was that, in a bank or a money broker?
That was at a money broker's, just off of Bishopsgate, not far from Liverpool Street.
Not Fulton Prebon, was it?
No, it wasn't. No, it was a company called Euro Brokers who were bought up by BGC Partners, who are based out of Canary Wharf, and that's where that journey went. Yeah. So it was that's where things began, and that went okay. I was doing okay there without really having any idea what I was doing, and then the 2008 crash happened, and that was the end of that. And I went back to, I was living outside of London at the time. I was living in the middle of Essex at the time, just north of Chelmsford. And I had decided that I didn't particularly enjoy the very silly early morning commuting on a train into London every single day. And so I decided, well, I'll see if I can find a job more locally. And more by luck than design, I fell into a career in the sort of marketing end of things, and I started off being the sort of marketing head for a business consultancy firm, and that went quite well for a little while. And then I was headhunted to go and head up the sales and marketing team for a property tech business in Essex as well. And went and worked for them, and they were acquired by Zoopla in 2014. As that was all going through in the early days, I decided to step away and set up my own business. I'd kind of given up the pretense that I could work for other people. I'd kind of been trying to convince myself that I could work for other people for most of my career up until that point, and then realized that just wasn't me. So I set up my own business in 2013, and that was it began life as a very run-of-the-mill digital marketing agency. We built websites, we built CRM systems, applications, things like that, and we ran some social media campaigns and some SEO campaigns for companies, things like that. Within a reasonably short space of time, it became apparent to me that you were just going to be in a price war in that industry, and so I repositioned it as a SaaS platform, and allowed customers to come in and kind of scale up and down monthly depending on what they wanted, and that made it a much more sustainable business model. And then in 2020, got an offer to sell it. That was a pretty decent offer. I was quite happy with what that offer looked like. Sold it, and moved on from there. and kind of ever since then been involved in the venture capital space in one way, shape, or form. And I kind of began my early days as more of a consultant and NED and so on in that space, and was working in and around a couple of different industries and a couple of different kind of guises in that space. I ended up helping to co-manage a family office network out of Zurich in Switzerland. That was going quite nicely, but when it became evident to me that the US was the place that I wanted to move to, I'm an American citizen anyway. I've had American citizenship since I was born. My father was born and grew up in America, and so I've had the passport since I was born. So when it became apparent to me that that's where we're moving to, I decided to step away and kind of clean slate it completely, and set up upon relocating to Texas, Sparton Ventures, and I brought a couple of co-founders into that, and we spent 5 or 6 months planning out and refining the model, and that brings us to kind of near enough today.
What made you move to Texas?
A whole load of different things, to be fair.
And Spartan Capital, I mean, what made you decide to sort of get into venture capital and investment type business when you've come from obviously CRM systems, websites, general consulting? It's quite an interesting move.
Yeah, I mean, to be honest, it was always a space that I was interested in. I always enjoyed listening into what was happening there and keeping an eye on what companies were emerging and what they were doing, and it kind of, venture capital kind of became a thing while I was growing up, really. While I was coming out of my teens into my 20s, that's when venture capital really started to pick up very significantly around the world. It's when the kind of Silicon Valley ecosystem really launched and really became what it was, and so I'd always had an ear to the ground on it. I'd always been watching it, looking at it, seeing what was going on, and I'm an ideas person. I'm someone that's drawn to ideas, new things, innovations, new ways of doing things, new ways of approaching things, and as a result, my personal drive takes me towards playing around with new ideas all the time. And venture gives you not only the ability to do that, but the excuse to do that. You've actually, in order to be good at venture, you've got to be looking at lots of different new ideas all the time, and you've got to be playing around with new ideas all the time. So it kind of fits quite well for me as an ideal kind of career.
So tell me a bit about Spartan Capital and Spartan Ventures, how they operate, what you do day to day, what solutions you fulfill, etc.
Sure. So we're slightly different in terms of the way we structure. So we're not a typical venture capital fund. We are a venture company. So we operate as a standard company structure. We bring investors into the company liquidity pool, and then we use that liquidity to make investments. And we invest into a number of different areas. So Spartan Capital is pretty much the holding company. It was the original company. It's kind of just the holding entity now, and Spartan Ventures is now our operating entity. That's the one we kind of do everything through. And so we do a number of different things through that. We've built a platform out, as you touched on when you were introducing, and so that's like a private deal flow kind of area where our clients, when they register with us, they go onto that platform, and so they're pushed out to other investors in our network. And we obviously take them through our investment management process as well. And then in and around that too, we provide advisory. We help companies structure themselves. We do some private equity stuff as well. So we've got around about 30% of our portfolio is in other assets besides venture. So we do some M&A, some roll-ups. We do investments into oil and gas deals, for example. We do some real estate. There's a few other different things that we do alongside that, and we do that partially because it allows us to hedge what happens on the venture side, but also it just gives us an overall more sustainable model.
How do you use analysts or investment banking services to decide what to go into and what not to go into?
Yes and no. And so we we look at a very large amount of deals, and then we've got our own systems that help us filter those into a smaller list of things that we're going to take a look at. And then depending on what those look like and what stage they're at and so on, we may or may not bring in outside advice or measurements, metrics, and so on to help us make those decisions. It really depends on the specifics of the deal. In all honesty, in the early stage venture, there's not really anything much that you can do beyond looking at the standard metrics and talking to the founders and assessing the founders and getting a gut feel for whether or not you think they're the kind of people that are going to make it happen. In all honesty, in early stage venture, you're backing the founder. You're investing in the people. You're not really investing in the business per se. You're investing in the people and your faith in their ability to execute.
So what's your process? Talk me through a deal like process,
Sure.
from beginning to end, so I can understand actually, how you operate.
No problem. So we start out with a basic application. So they put the basic details in that goes into our application system. That's a private application system, so we don't just let anyone come onto the site and fill that out. Where we have to have met someone, spoken to them, and then at that point we'll tell them whether or not we're going to invite them to apply. When they do that application, it's fairly basic to begin with. It's standard basic information of the company, a couple of documents we ask them to upload and so on. And what we're doing at that stage is just a very quick first look. First of all, is there a reasonable match on thesis? If there's not a reasonable match on thesis, does it match our other side of things? Does it match our private equity side? Does it match our other criteria that we're looking for? So we do a quick match on there, and we do a very quick background check on the names and so on the cap table, just to make sure there's no major red flags that crop up at that moment in time. And so that's the first step. So once they're through that first application process and we've accepted the application, they then move into our kind of standard process of working them through our funding. And that involves a couple of different steps, but the first step is a larger information request. So we'll send them a request for further documentation, and that can be anything. It really depends on the kind of company. So in some circumstances, it's right. Okay, we need to see your proof of IP. We need to see patents. We need to see technical details of your product or whatever it happens to be. We're doing a slightly deeper due diligence at that point. And then alongside that, we then do a founder profiling test. That's where we ask the founders to go and fill out a set of profiling. And what that profiling is doing is it's telling us their talent profile. It's telling us what we call their founder DNA profile. And it's telling us their personal values profiling. And so we take those three things and we merge those together into a single report. And again, we use those to base on where the best what the best fits and where we see strengths and weaknesses with those founders and so on. Assuming they get through those two steps, then the next step from there is then when it starts being reviewed by our IC. So our investment committee will start reviewing it. So usually they'll have an interview with somebody from our investment committee, at least one, sometimes more, where some of the investment committee will dig into some details to them. Usually holding their feet to the fire a little bit and really getting into some slightly more uncomfortable conversation. And then based on that, we will then take it to a vote within the investment committee as to whether or not we're going to make an offer. If we are deciding to make an offer, we'll make a non-binding term sheet to begin with to say this is going to be our offer. And then once we've submitted that and that's been accepted, we then go into the deeper due diligence. That's where we'll bring in our outside counsel, lawyers, and so on to do the real deeper digging, just to make sure there's nothing we've missed. And assuming that all passes, we then do a binding offer and we then make the investment.
So your funds, do they come from within, or do you raise funds from other interested parties?
Both. So we put some of our own in, and the majority of the fund is from outside investors.
Quite impressive from coming from being a money broker to to doing what you're doing now? I mean, how did you educate yourself in all this?
I educated myself in this the same way that I've always educated myself, which is jump off a cliff and build the plane on the way down. It's just the way that I've always approached everything. Is just start and kind of figure it out as you go, and meeting the right people, getting the right people around you, and bringing on the right mentors, and really getting to know people in a serious way, and people who are playing at a different level of the game to yourself. Those are the people that we make sure we bring around us as much as possible.
Yeah, it's funny. I had a very similar conversation with a guy in the States uh, who will remain nameless, but he started out in investment banking many years ago. He's an older chap, and you know, the company he worked for disappeared, and he fell out on his own, and he started doing venture capital and investments, and he built up a network of family offices, like huge family offices, over 200, and he then, goes out, looks for a deal like you're looking, then he talks to his network, he puts in his money, and then he goes to the family offices and says, well, this is the deal. I'd like to raise an extra 100 mil or 50 mil. How much
Yep.
would you like to take part in?
Yep.
And off he goes, and that's how
Yep.
he's built his business.
Yeah. Yeah. We operate in a similar way in a lot of circumstances as well. So, we raise the money in so that we can make investments into the things we are looking at. But in a lot of situations, there's a very good deal that we don't have the physical capital on hip to take part in, and or to take the round of, or whatever it happens to be. And so we will quite often at that point we'll bring that deal in, and then we will go and speak to our other investors, and we'll get people together and try to get things across the table as a kind of a syndication or a consortium or whatever you want to call it. We'll try to bring those things together and make those things happen.
Are your partners actively involved with you on the deal front?
Yeah, pretty much everyone in and around us, takes part in both originating deals and reviewing the deals and investing in those deals and so on. So everybody is involved, across the board.
Interesting. You mentioned oil and gas earlier. How do you actually use them? Do you take positions in them? Do you play the ETFs? How do you actually use them?
It really depends on the kind of deal that it is. I mean, in some circumstances, it's like, there's so many different kinds of deals within the oil and gas space. I mean, there's exploration ones where someone's just raising the money to go and drill some speculative wells and see if there's anything there, and obviously that can be a very high risk investment, because there's a chance you go and set a well up, drill down, and hit nothing. So there's that kind of deal. And then there's the other end of the scale is refinery building and so on, and those are usually minimum around about $1 billion usually to build one of those out. So it really depends on the particular deal itself. Most of the time in larger scale stuff, we're simply bringing the partners together that we know, the people that we know that operate on that kind of scale. We're just bringing them to the project, and then we're just taking a small piece of participation in that, so that we're getting something for helping bring the deal together, but we're not operating as a broker. We're actually taking a piece of it as part of the deal.
Really interesting. I find it inspiring. You have quite a broad spectrum of interests. Do you find that to be a strategic advantage within the markets you play?
Yes, it's got a double-edged sword to it, in that obviously having a wide amount of interest means that you can get very flooded with a very large amount of deal flow and feel a bit inundated sometimes. But my feeling is that by having that wider interest, we're more likely to achieve the outcomes that we want, because we're not overly niching ourselves. I've always had a aversion to going too narrow in a niche. I think that if you do that, you can do very well, but you're you're generally completely at the mercy of the 80-20 rule. And so, you know, you can literally lose 80% of what you have overnight if something happens in that niche that you're not able to deal with. So our approach is to be a little bit more general, although we've got some favorite areas and some things we tend to target and some things we look at as more, you know, as more in thesis, if you like, of the kind of things that we prefer to go for, but we can go outside of those for the right deals.
I think I read that you like energy technologies, computing technologies, hardware and software infrastructure, and then broader wellness theme that
Yes.
includes longevity, food production, supplementation, and keeping people away from drugs and doctors.
Yep.
Quite a wide lens, but any reason why, especially on the latter part,
Well,
keeping people away from drugs and doctors, what
sure.
sort of inspired that?
Well, the overall approach is that you know, my personal feeling is I care about civilizational advancement, and one of the problems with the modern world is how much there has been a kind of corrupting of the way things are supposed to be by you know, call it nefarious interests, and the drugs and doctors, the pharmaceutical industry, as far as I'm concerned, is designed almost entirely not to fix anything, but to be a permanent profit model of continually patching up problems that people have, whilst continuing to keep them sick for as long as possible, because that way you get them for a customer as long as possible. That can sound a little bit cynical, but unfortunately I have not seen.
I agree with you.
Yeah, I have not seen anything to assuage, you know, to dissuade me of that notion, and so the way that I see you know, health is that you're the most healthy if you never have to go and see a doctor. If you never have to take any drugs, you are generally going to be a very healthy person. I'm somebody that doesn't take anything unless I absolutely have to. I'm someone that doesn't. I don't believe in most of the stuff that they tell you you're supposed to take. I don't even take pills if I've got a headache. You know, I just you know, my entire approach is to look at because our bodies evolved within the world, and the world has got all of the fixes in it. Natural medicines are all there, and yeah, there can be a certain amount of kookiness in it, and there's definitely people in there who are snake oil salesmen and selling you stuff that really does nothing as well. But my honest feeling is that the pharmaceutical industry is a burden on civilization, not an asset of it.
Okay, yeah, that's fair enough. When we talk about venture capital, etc., are you only looking at early stage opportunities, or do you actually look at existing businesses that could be in trouble, and if they were revamped, could do a lot better?
So we would split those two into two different categories. So within the venture side, we're mostly looking at companies from sort of pre-seed to Series A, relatively early stage, relatively early on in their journeys. You know, we will look at companies when they're pre-revenue, but we want to make sure that they're at least post-product. They've at least developed a product. They've at least got some sort of prototype, something that tells them that there's some sort of customer and some sort of market there, and they've actually developed something they can sell. You know, we want to be looking at least at that point. But then on the other side of things, struggling companies, things like that, we would classify that more in our private equity side. And so, yeah, we do look at things like that. So we're in the process of acquiring a car finance company at the moment, and that's based out of Ohio, and we're acquiring that because it's been around since about, I think, 1965. The owner is well into his 70s and deciding he wants to be retiring, and And what he needs really is the ability to pass it on. He's had his foot off the gas for about 10 years, so it's kind of tailed off a little bit. It's got the opportunity to be stepped into very quickly, ramped up, and get a anywhere between a 7 and 14x return on the investment that we put into the company. So stuff like that we look at quite a lot. Yeah.
So what's the long-term plan? Do you look to IPO these, or just sell them as a private entity?
To be honest, we would look at most of these things as private entity sales. IPOs have dropped off quite a lot in recent years, and there's a couple of reasons for that. Not least of which is the amount of red tape involved in an IPO these days, and how much and the actual physical cost of doing an IPO. Has meant that IPOs themselves have reduced in number. In addition to that, it's you're seeing there's a lot of companies who have IPO'd. They've had overinflated values at the IPO, and then they've dropped below that value afterwards, and it's made a bad impact on the company. So the IPO route is a route that fewer and fewer companies are actually going for now. Most of them are looking at that private sale and private market exit strategy. And to be fair, the vast majority of what we would be investing in and looking to get involved in would be looking at that private sale exit as well. Not least of which because of the time frame involved. If we're going into a company at seed stage, realistically, you could be anywhere between 8 and 10 years before an IPO is actually viable for them. And so we would much rather be going into a company investing for 3 to 5 maximum, and then taking our chips off the table at that point. So we're working in a shorter term marketplace, so IPOs aren't really the thing that we're tending to look at.
Well, that's interesting. Do you ever look at SPACs or anything like that?
Excuse me. We do.
I mean, they were very popular about 10 years ago, but I think I've seen recently, in talking to quite a number of different people in our industry, in financial industry, that they seem to be coming back more in vogue.
Yeah, I think so. I think that they've still got a place. They're definitely less popular these days. A lot of the time we're doing things through what you would call an SPV. Most of the time is how we do most of the investments we're working on, go through SPVs. And an SPV can effectively be a SPAC, but just by another name. So although
it just doesn't get listed.
It just doesn't get listed the same way. Yes, exactly. So it's it's something that we're aware of. We've never really done one, but we've looked at a few. We've had a few sort of cross the cross the bows, as it were, but we haven't got involved directly in one as yet.
Going back to investors, what do you think many investors still misunderstand about backing foundational or enabling technologies at an early stage?
I think it depends on the kind of investor, to be honest. There are plenty of investors who completely get the fact that what you're investing in there is the person rather than the technology. Even if the technology or the idea or so on sounds really incredible and sounds really good and could be a game changer within the space and so on, ultimately you're still investing you're putting your faith in the founder's ability to execute on that. And so I think a lot of investors do miss that particular point, or they'll get too focused on the technology, or they'll get too focused on the market, and they'll look at the technology in the market and they'll say this is too difficult, it's too heavy a lift to achieve it. Whereas it may very well be the case that the founders themselves have got all of the things they need in order to actually achieve that. And it can be vice versa as well. You can have a great idea with a founder that doesn't have the ability to execute, and no matter how good the idea is, it won't get anywhere. So there's a really there can be a bit of a disconnect there, and figuring that out is difficult. It's the one thing that every investor, especially early stage investors, will the unknown. As soon as you put that money in, you never know if the founder is definitely going to be able to execute or not. And you can only hope that they will, and you can obviously provide help, you can provide support, you can do what you can do to try to get it to where it needs to go. But in all honesty, unless you're running the company yourself, there's no way you can guarantee that.
Sure.
So the faith is in the founder, and so many founders have let people down, and it always makes me laugh every time you hear about a new Forbes 30 under 30 founder who's been convicted of fraud. It's almost like the prerequisite list of founders committing fraud is if you get on that list, you're almost definitely going to prison sometime in the next 5 to 10 years. It seems to be.
When an investor comes to you, I mean, what's the time frame you give them? You sort of lay out before they can get their money back or might see any money back?
To be honest, it depends. If an investor's investing with us, because of the way we operate, we don't operate like a standard fund. So we're not putting all the money in within a particular time frame and then exiting all at a certain point as well. We have numerous liquidity events across time frame. We effectively operate as an evergreen kind of thing. So whenever there is an opportunity to create a liquidity event, we can do that. We can bring that money back into the liquidity pool, and so we give investors the opportunity to draw off of that at particular times of the year. And then what we do with anything that's left over is we redistribute. So we've got a kind of a metric around that, how much they're allowed to take off the table at any given time, and when they want to remove money out of the fund and things like that. But we usually ask that they're putting it in for a minimum of 3 years, but it does vary on the amounts they're putting in and what they're doing with it, and what we're doing with it, and so on. But the way that we've set it up is there's the opportunity for them to take money off the table throughout that period as well.
Fantastic. What does investor confidence look like at the moment in your, especially with what's going on in the world, etc.?
Yeah. Every time there's a little bit of instability around the world, you always see an immediate retraction in the investment space. It's just a natural part of that cycle. That being said, they're usually very short-lived. You usually get a short contraction, and then things kind of go back to normal pretty quickly. One of the major reasons I moved to the US instead of the UK is because the UK investment space is like a bit of a ghost town. There's so little investor confidence. There's such a aversion to risk. There's a generally negative mental attitude to just about every kind of industry and opportunity in the UK, and that's predominantly because of how bad the entire country has degraded over the last couple of decades, and not to mention how bad the economy has become and how much worse it's getting with the current government in place, chasing all of the people with any money out of the country, and so the US is a far better system for that. There is a lot more available capital. There is a lot more. There's a lot more opportunism. There is a lot more confidence and speculation. There is a far better attitude to risk. And so different areas of the world operate differently. I know a lot of people who are based out in Dubai who say that it's very similar out there, with a lot of confidence, a lot of available money, people doing a lot of things. I think there are areas of the world that are doing well and areas of the world that aren't doing well, and there's also industries that are doing better and industries that are doing worse. And especially in the US at the moment, there's a lot of money going back into the oil and gas spaces, into the manufacturing spaces, into the defense technology spaces. There's a lot of money going back that way. And a lot of it is pulling out of the climate techs and and all of that kind of stuff. Mostly because the vast majority of stuff in the climate tech space is BS as soon as you look under the surface. It's one of those things that's been created by ideologues, and the moment you actually look at it from a genuine business point of view, it just doesn't stack up, and it's having money put into it for ideological reasons as opposed to real economic reasons. Our approach is to try to improve civilization, and that's the reason we picked those three key areas, because energy, compute, and wellness are the three areas that have the biggest impact on civilization. You can't improve civilization without more energy. There's no such thing as a low energy rich country. The richer you get, the more the higher your standard of living, the more energy you need to consume. And the more energy you will consume by having that higher standard of living. That's just a fact. And so the requirement for energy is only going in one direction. It's only going exponentially upwards. Alongside that, compute is the enabler. Compute now runs everything. Compute runs banking, it runs transport, it runs schools, it runs absolutely everything. Compute is now the thing that sits underneath the fabric of pretty much the entirety of our civilization. And so again, the requirement for that is only going exponentially upwards. And then finally, the wellness space. We look at that one because people need to be healthy and alive for as long as possible to take advantage of that improved civilization, and civilization will definitely improve if we're able to get fewer people on drugs, and have them generally healthier and living longer and happier. That's the reason we've gone for those areas.
Excellent. So how do you find deal flow in those areas? Is it hard to? Is it easy to find opportunities while maintaining discipline on what you take?
I would say that's a constant battle. That's continuous. We get a very large amount of deal flow coming through. Being able to sort through that and find the good ones is always a challenge, because you're getting volume in and you're having to sort of sift it out to get the real good stuff. Equally, you need that kind of deal flow volume happening in order to make sure you get the good ones in. If you restrict your deal flow down, you'll naturally miss more of the big opportunities. And so it's a constant refining process of where we get deal flow from, how we initially assess it, and then how we then take it to those next steps and work it through each stage of the filter. So we get a very substantial amount of deal flow. We get a lot of deal flow come to us. We're certainly not struggling for deal flow. Where we sometimes struggle is just in our ability to manage that deal flow.
And I think you mentioned also that you look at property.
Yes. So
tell us about that and how that affects what you do, and what sort of percentage is of your interests.
No problem. Well, let me be the first to say, I find property outstandingly boring as an investment space completely. I've never been particularly interested in real estate as an investment at all. I've just always found it just far too incredibly boring for me. There's no creativity in it. There's no pushing the boundaries. There's nothing new. It's just bricks and mortar and percentages nudging up year on year. To me, that's not that exciting. That being said, it's a good asset to put capital into because it's a safe asset, and it's a good asset to ensure that you've got a reasonable amount of incident-proof assets sat there. So that's kind of what part of the reason we do it. We've got a mandate from a bank, for example. One of a large bank is mandated and with us to find property and investment opportunities for them, to provide financing into a whole load of different things, businesses with hard assets, real estate across the US and UK and so on. Quite a lot of different opportunities that they're actually looking for. So, it's an asset that I understand is worth buying and holding. I let other people in the organization deal with it because I find it way too boring for me. So I let the people who care, who are more interested in it and understand it better deal with that for the most part.
You mentioned that you run a lean team, and you're wary of large headcount because of previous experiences,
Yes.
which I can understand. Tell me, how does that affect your operation? I mean, you said that you have struggle at times managing the deal flow. What other bottlenecks, do you find by having such a lean team?
To be honest, the major bottleneck in the company is me. I'm the biggest bottleneck because I'm the only person that does what I do, and within our company, I'm the only person that can do what I do, and so my capacity is obviously limited, and so therefore the amount that I'm able to handle is the primary bottleneck that we actually deal with as a company. So what we're doing is we're fairly strongly utilizing AI to automate a lot of processes that take a lot of the things off of my plate, and improve efficiencies in a lot of different areas. And so that's how we're dealing with with the bottlenecks for the most part. But there's always bottlenecks. Even if you've got a team of 1,000 or more or 10,000, whatever, there's always a bottleneck of some sort in every company. So I don't ever expect that we will eliminate them, but I do think that by utilizing things like AI correctly, you can reduce them or optimize them to have the minimum impact. So from a bottleneck point of view, the biggest gripe I've got is that there's only one of me.
Fair enough. What about moving forward over the next 5 to 10 years? Where do you believe the biggest opportunities will sit? Obviously, the world's in a massively going through a huge transition. It's changing in every shape and form.
Yeah. Well, I think there's a couple of areas where opportunity is going to be geographical. So there's going to be some places of the world where there's an opportunity in a particular space that won't be an opportunity somewhere else. I do think that there is going to be an abandonment of the over push for green energy. And if you're paying attention to the news cycles and things like that, you've noticed that all the governments have gone quite quiet about that recently. And the reason they've gone quite quiet about it is because of the AI race. And AI requires so much power, you just can't use green energy to do it. You have to upscale your fossil fuel energy infrastructure and realistically nuclear. That's the only way to actually achieve the power that you need to in order to win that race. So the green energy thing will die in the not too distant future. There's certain elements of it that will have a place, but it was all based on mostly lies anyway. But certain elements of it will have a place. Solar does have a place if used properly and effectively and so on. There's a place for that. Wind is pointless, and will never actually provide anything even approximating a good spot for it. And part of the problem is the grids themselves, upscaling the grid. So there's going to be a lot of work involved, and there's going to be a huge amount of investments upscaling grid infrastructure. And so there's going to be that's going to be worldwide. Those kind of things are going to be happening.
So do you think global warming is blown out of proportion?
Oh, completely. The world has changed temperature, 1,000 times before we were burning anything, and it's historically at one of its. We're still technically in an ice age, by the way. If in case for the people who aren't aware, as we are living today, this is still technically an ice age. It's what's called an interglacial period in an ice age is where we currently live. We are right down at the bottom of a trough of global temperatures going up and down. What's been happening recently there's been a mild uptick. Now that could just be a little blip before it drops even lower, and that'd be terrible for us, because if the world drops into another ice age, almost everyone's dead. Whereas if the world gets warmer, things get better. There's more plant life, there's more animal life, there's more sea life, there's more everything if the world gets warmer and you get more CO2 in the atmosphere. The whole idea that CO2 in the atmosphere was the enemy and the problem was completely fabricated in the first place. But there's the changing of global temperatures is always going to happen, and I think the thing that I always find is the easiest way to talk to someone about this when they believe that they've bought the whole idea that carbon's the problem, is to ask them what the percentage of the atmosphere is made of carbon. And in case you don't know, it's 0.4%, and human input to that 0.4% is approximately 3%. So we account for approximately 0.003% of all of the carbon in the atmosphere is human interaction. Historically, CO2 has been as high as about 20 to 25% of the global atmosphere in the past. At the times that it's at its highest is when you get the most abundant life. You get the Cretaceous period, you get the Cambrian explosions, things like that. CO2 is the literal building block of all life. The idea that we need to reduce it is moronic. At the least, as soon as you look into anything behind the science of it, it's completely baffling. So yeah, I don't buy any of that at all, and I think most of the fear mongering was done for wealth transfer and control. And I think a lot of people have woken up to that now, and especially now that you've got the administration that you've got in the US, it's moving away from that completely. There's so much more investment going into the oil and gas infrastructures and onshoring energy infrastructure and so on. I think that's had its day now.
Okay, well, I think this podcast has been very, very interesting. And I have to say, I think you put Essex back on the map.
Well, even though I'm in Texas now.
Even though you're in Texas,
Yeah.
you originate from Essex. And
Yeah.
I'm very, very impressed in your journey. It's clearly a platform that you've built around selective conviction, clean execution, a very deliberate view of where capital should flow next. I think the humanitarian side of your business is absolutely amazing, and I'm very, very, very inspired by what you've got to say. If people and listeners want to get hold of you and want to know more about Sparton, how can they find you? Where can they contact you, etc.?
Sure. So the best place to find me is on LinkedIn. It's search Alex Seleska on LinkedIn. I'm the only one that comes up, so I'm nice and easy to find. So find me on there. That's where I do most of my social media for me in terms of business is done there. And our website is Sparton.ventures, and that's Sparton with an O rather than a Sparton .ventures. That's the place to go to our website and find out more about the company.
Alex, well, I want to thank you for being a guest.
Thank you.
I'd like to thank everybody for listening in. I'm Gary Wayne, Wise Tech for Wise Money. We'll be back in a couple of days with another episode, and I look forward to talking to everybody then. Thanks very much, Alex.
Thank you.
I thought that was great.